Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today for the third and final segment of today's show. If you missed the other two segments from today, you can head on over to our website, www.dlblain.com, and in a week or so we'll have archived copies of the show posted. So this is the third segment. We've been talking about some mistakes that investors make in general, how good investors focus on how to not lose money. And we started last segment talking about what I think is a big mistake people are making today, which is flooding into the bond market. Not only are they flooding into the bond market, but obviously unhappy with the safety and security of a 1.7% yield on the 10-year Treasury. They're looking for other types of bonds to get increased amount of yield. Now, there's nothing wrong with investing in bonds. We still encourage our clients to own some bonds, but we don't want people to forget one of the main reasons to have good, high-quality bonds in your portfolio is to buffer the declines of the stock market. And so, yes, the treasuries aren't making a lot, but they're in there to add a buffer to the stock market. But a lot of people think that, well, a bond's a bond, and so they're stretching out for yield from their bond portfolio. Instead of accepting that 1.7%, they're going out into high-yield bonds, preferred stocks, emerging market debt, some of the higher-yielding areas of the market, as well as REITs. Now, there's nothing wrong with those type of investments built into a diversified portfolio. In fact, we at sometimes use all of those. But to take the core bond portion of your portfolio, the high-quality bond that is there to provide that diversification and buffer against the stock market, and to go buy high-yield bonds, that is very dangerous. You're increasing the risk of your portfolio significantly. And I'm not sure that a lot of investors understand that. So credit risk, moving away from high-quality corporate or high-quality treasury bonds into these other areas, people need to be very cautious. As people have been flooding into it, the price has been going up, and so the yields have been coming down, and so the spread is at a very narrow point compared to where it should be. So you should be compensated. So if the U.S. Treasury is paying 1.7%, there needs to be a premium for you to invest in high-yield bonds. And there certainly is, high-yield bonds paying about 6. Historically, they should be paying more like 9 or 10. But because people have been flooding to them, that yield has been compressed. We see other people stretching for yield by increasing the duration of the portfolio. Longer-term bonds pay more than short-term bonds. For example, if you go out 20 years, you may be able to make 3.5% on a high-quality corporate bond. In fact, we've seen clients come in with bonds, that mature in 2032, 20 years from now. Well, that's fine and dandy to collect that 3.5% coupon, but if interest rates rise even 2%, that 20-year corporate bond yielding 3.5% would suffer a drop of 23%. Now, this is the bond portion of your portfolio, not the supposedly aggressive stock portion. So watch it when you extend the duration of those bonds. The other thing I've seen, investors may be consciously or unwittingly embracing leverage in their portfolio, either borrowing money to invest in bonds on margin, or even worse is some of the mutual funds, and especially the closed-end funds out there. A lot of closed-end bond mutual funds, a lot of them use leverage to enhance the returns. So they're borrowing money to enhance that return. So when looking at investing in the bond market, make sure you understand what risks you're taking, what you're trying to achieve with the bond portion of your portfolio. And I would submit that stretching for yield because you want the income, especially in light of the tax increases that are coming on income, that's another story. But you definitely don't want to stretch for yield at the expense of having a solid, high-quality fixed income component of your portfolio. Now, what are investors supposed to do? You've got on the one hand very low returns. On the other hand, you have what people perceive as an alarming amount of risk in the stock market. Well, here's the secret. Here's the secret to investing is that's what you're paid to endure. If investing in something carried no risk and it didn't give you a queasy feeling in your stomach sometimes, then you don't deserve to make more than a pittance amount of money. That's just the facts. And so when you invest in the stock market or some sort of growth asset, you are accepting what's called volatility risk, number one. The risk that the price of the thing goes up and down, and at the end of your 20 or 30-year investing careers, you don't know what the end result will be. That's why you can make more money. It doesn't mean you must make more money, but that's why the potential or the expected return is higher. You're getting paid to endure it. I mean, that's the bottom line. If there weren't bear markets, then there would be no incentive. If it was a sure thing, then they wouldn't pay that much. The other thing that you're getting paid for is what we call liquidity risk. So volatility, enduring the ups and downs. Liquidity risk, once again, is related to that time horizon. Is if you need your money, tomorrow, and you need a certain amount to go to college or buy a house or something like that, that's one thing. But if you're talking about long-term money, liquidity risk and being willing to stay invested in something for a number of years, you're accepting that liquidity risk along the way. And so that's why you can make more money outside of the bond market. You're getting paid to take those type of risks, volatility risk, liquidity risk. And so when you're looking at the rewards out there today, there's tremendous amount of potential reward for accepting volatility and liquidity risk today, especially when you look at after inflation, a lot of bonds are yielding near zero. So when you're looking at your portfolio, make sure that you're not accepting unnecessary risk in the bond market for rewards that are not that significant and in fact are a lot of risk. And if you're willing to take some sort of risk, make sure you're getting a reward for it. And that entails investing in the growth type investments where you're willing to accept volatility as well as liquidity risk. Well, that's about all the time we have for today's show. Maybe we'll talk about this some more again next week. So for All Things Money, I'm your host, David Blain. I hope to see you again same time next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.